Welcome everybody, and thanks for joining our multi-asset webinar today. My name's Murray Anderson, and joining me on the panel today is Rupert Hare, Head of Multi-Assets, joined by Shriya Roy, one of our quantitative analysts in Rupert's team. Thanks for joining me. Folks, today's multi-asset webinar is all about looking back at the last quarter, reflecting on what we had expected to see and what played out during the quarter. It wasn't too long ago, Rupert, that we were sitting in this very chair talking about 2023 and what played out then. So let's reflect back on the last quarter, review what we thought was going to happen and actually what played out.
Interesting quarter, to say the least. Some people might think that it was a bit mundane, but really there were some big changes that I want to take you through today in underlying growth, inflation outlooks, rate paths going forward. So some big changes in the macro space. Within global markets, the only real star was US equities, driven predominantly by the US tech stocks. That puts US equities at even higher valuation multiples, which we'll cover as well, just to talk around whether there is still an investment case in US equities at these levels. But bringing it home, I think for home-based investors, the journey that they took was somewhat different. SA equities finished largely flat for the quarter, some ups and downs. SA fixed income with a bit of duration had a tough quarter, so we had high yields that got even higher, which meant that there's a bit of a headwind for duration type assets, which left out of the asset classes cash and income. So they were the darling childs of Q1. The lowest risk asset classes really did make a strong yield profile in the first quarter of Q1. But I wanted to first focus on the growth outlook for, in particular, the United States, which we think often cascades down into global different markets, including South Africa. And what we've seen in terms of changes to our outlook for growth, you'll recall that in 2023, we saw there was no hard landing, so the US didn't go into a recession. What we've seen now has been an increase in that growth assumption, and that's been one of the reasons why US equities have rallied in the first quarter. So let me show you what we mean by that. So as a reminder for those who have not seen this before, we have an indicator which we call the Prescient Economic Indicator, the purpose of which is to try and quantify GDP in real time. So GDP gets printed in arrears, 2-3 months in arrears for the quarter. What we're trying to say is where is GDP growth as of today? So not a forecast, it's called a nowcast, and it allows us to make decisions around investments with a much more up-to-date picture. So how it works is that we have hundreds of different indicators that go into an overall indicator called PEI. Those include things like business confidence surveys, income surveys, PCE, all sorts of different indicators get punched into this model. The model then finds a common trend and it estimates the real GDP in real time. So you can see here this dotted line is the current PEI. We can then read off that that we've got a real GDP growth assumption of just above 2% in the United States as we currently stand. So quite an accurate model. It's never going to be perfect, but it's quite an accurate picture compared to shooting in the dark if we didn't know at all what GDP was. If you look at it through time, just to show the sort of accuracy, you can see that it does pick up recessions in particular very quickly, and also rebounds from recessions. So if we zoom right in on the COVID scenario, you can see it picks up the downgrade in growth assumptions during COVID, and then it picks up the V-shaped recovery. So where are we at present? If we zoom right in at the end here, we can see an assumption on GDP growth of around 2.9 to 3%. So above trend growth, or just at trend growth in the United States. This is real trend growth, so it's over and above inflation. But I think the key to this story is actually not necessarily the number, but it's the principal components of that number. So what we do here is we decompose that PEI into the contributors towards PEI. Ignore the numbers themselves. What we want to show you though is the different contributions in different directions from the different families of indicators. So main theme here being that consumer sentiment in the United States is a strong positive contributor. So consumer sentiment includes things like Michigan consumer sentiment, expected business conditions, all sorts of different consumer-related indicators. Economic conditions on the other side are showing headwinds. So whilst there is a bullish consumer, there is still a bearish, if you want to call it that, hard print when it comes to economic data. The last one I wanted to show is in particular related to the Fed and why the Fed may or may not cut rates in future, and that is labor market conditions. So the Fed pays particular attention to the US labor market. One of their mandates is to try and keep the US labor market at what they would call full employment, so running on full steam. What a lot of people look at is this US unemployment rate, which is this tiny little bar here, which is positive. So US unemployment is near all-time lows. But what we've seen degrading over the last couple of months have been other indicators like US jolts in the construction sector, in the transportation sector, in the retail trade sector. And that's a broader based measure of unemployment in the United States. So interesting to see that there have potentially been some turns when it comes to the labor market conditions in the United States. So what's holding up the ship? Well, what's holding up the ship is this consumer sentiment part. But if we see that consumer sentiment bar begin to turn, then the Prescient economic indicator will start to degrade in terms of growth assumptions in the United States. At the moment, it is pretty much peaking. It might go higher, it might go lower. We can't tell at this point in time. Wish we could predict it. But if we start to see this going downwards, then it becomes a bit of a headwind for the United States. And that's in particular important for US equity markets, which are facing near all-time highs in valuations. So highs being a bad thing in things like the price to earnings multiple.
Thanks, Rupert. Interesting insights. So the Fed has been trying to fight inflation with interest rates and now being prolonged at this high level. We expected them to come down sooner. What's playing out there now?
I think it's important to take a step back and think what the Fed actually does with interest rates. So the Fed hikes interest rates when inflation is high in order to try and get inflation lower. So it's important to look into inflation and see what the story of inflation is right now, and also what the story potentially is or could be with inflation in the coming months. So let's just look into US inflation to start and see what we can see in terms of the trends there. So looking back over the past couple of quarters, we have been tracking inflation, quite a beady eye on inflation through the months. And what we're looking for here is for inflation to be coming down and for inflation projections to also continue to come down. So the Fed has a target inflation rate of around 2%, and we're looking for that magical 2% number before the Fed starts to think seriously about cutting rates. If we look at core CPI, which is one of the primary indicators the Fed uses, you can see that on the whole, the total has been steadily coming down. And we've visited this in the past, but the primary component that has been driving that decrease has been shelter. So shelter is the largest component within this index. And if we turn everything off and we just look at shelter, you can see that shelter peaked in around March 2023 and continues to come off. Now, shelter is a lagged component. It means that it takes what we've calculated as 18 months to come through in this inflation print, which means that we can, with a high-ish degree of certainty, I can never be 100% certain here, but we can predict the shelter component by looking at real-time pricing on shelter, so household prices in the United States. And that has continued to come in. So we're quite confident that this particular component will continue to come in, which means that if we re-enable all of the components within the core CPI basket and turn off shelter, that the Fed is well below that 2% target. So all else equal, and all else is never equal in finance, but all else equal, if purely the shelter component comes in, then the Fed has got quite a solid reason to start cutting rates.
Thanks, Rupert. That's obviously the US-centric central point or around interest rates to get that timing right. But obviously the rest of the world, central banks are looking at when to cut rates as well. Let's bring it home to South Africa. What do we expect from a rates perspective in South Africa, and when do we start cutting here?
Very topical for the first quarter and the time that's passed since then. South African rate expectations have flattened out. In other words, we go back to last year and the market was pricing for significant cuts from the SARB, and now we are flat in rate expectations. So interesting dynamic. That's not necessarily because our inflation assumption has changed, but one of the commentaries that's come out in the last month or so from the SARB is that they are looking to target a lower CPI band. This will not be immediately, and we don't think that that's possible immediately, but they're looking to target a 2 to 4% CPI band. The second thing in that space is the current interest rate differential. So whilst it might seem that our current key rates are pretty high, our cash rates in particular, the United States also has very high cash rates. So let me show you what that means for the rand. So focusing in on the interest rate differential, which is essentially the carry trade between South Africa and the United States. We see if we compare 3-month JIBAR to 3-month LIBOR, so South Africa to the United States, the spread is currently just shy of 3%. That's far below the long-term median, which means that for an investor sitting in the United States making the decision to either buy dollar-based cash or SA-based cash, it's not as easy or not as clear-cut of a decision to buy into the front end in South Africa right now. So why that's important is that in order to achieve rand stability, you need the rand to be attractive for offshore investors. And the rand is attractive when yields are attractive in South Africa. Yields are attractive towards the back end of the curve in government bonds in South Africa, but they're not nearly as attractive at the front end. Now the back end includes the probability of default. The front end has limited to no probability of default, but currently you're not really getting paid for taking on rand specific risk. And if we just go back into what that means for the market, if you look at the FRA curve 6 months ago, even 1 month ago, what this shows us is that the market was expecting roughly between 1 and 2 cuts in the near-term future. What the market's now expecting, if we turn those two off, is no cuts.
Thanks, Rupert, for that insight. Shriya, I mean, this interest rate environment is very difficult. Obviously, everybody's poised for rates to be cut. What's great for investors is you've had the high cash rates domestically, so those investors that are sitting in cash have benefited. Those sitting in offshore US cash, for example, have benefited. But obviously, the global macro picture, hasn't really changed or deteriorated too much to see that cutting cycle. How does one construct asset allocation views now, given we expected rates to cut, but maybe just contrast that from what we started the year thinking about and where we're going to next from a global point of view and how we structure portfolios?
Sure, Murray. So we have millions and millions of data points that feed into our system on a daily basis, and this informs our view and it updates our view every single day. Now, we are a systematic manager, as you are aware. So what this means is that when we make views on asset classes, and we've got 27, 28 asset classes, we're able to be unbiased. So we don't need to involve our feelings around, the elections in South Africa or the US, how we feel about Trump or Biden, how we feel about US growth or China even. So it allows us to be a lot more level-headed when making these decisions, which inevitably leads to us being consistent in the long term. So let's just break it down a little bit more, see where we are, and see what's changed over the quarter. Okay, so if you've watched one of these webinars before, you'll be very familiar with this table. What it essentially shows is where we're currently positioned across our 27 asset classes, from equities to bonds to credit, and even some currency across the world. So from a high level view, you can see that we are quite neutral to moderately positive overall. Now, this is quite different to where we sat at the beginning of the year. So let's go back in time, because with the power of data, that's actually something that we can do. So let's go back to, say, the 3rd of January, and you'll see our views shift. You see a lot more red on the screen now. And this just means that in January, we were actually neutral to bearish overall. We see a bright red, strongly negative in US equities, and a lot more of the equity markets were actually negative. We're also a bit more negative on credit, and currency just seems like quite a mixed picture. Fast forward now to today, we're doing quite a lot of time traveling. And what's been driving this is the improved global growth outlook that Rupert had alluded to earlier. Now, if we dig a bit deeper, let's look at South Africa. SA equities, we're moderately positive. SA bonds, also moderately positive. The Rand, also moderately positive, and SA ILB is also moderately positive. We promise we don't have an SA bias. This is all based on data and evidence. Now, what's common across these South African asset classes is that they have a very attractive valuations case. SA equities, we look at fundamental ratios like your PE, PB, price to sales ratios, and all of those point to very cheap valuations. They're all quite low in comparison to where they were historically and in relation to their long-term median. In SA bonds, we're also seeing very positive valuations. So there are still some really attractive real yield profiles coming out from SA bonds. There's attractive term premiums. So as an investor, you're getting compensated for taking on additional term risk as well. One of the asset classes that's actually moved over the quarter has been US equities. Now, that's quite an attractive one or something that's quite topical. So let's go into that and dig a bit deeper into what's actually moved this asset class and actually see why we are actually positioned here. So overall, we are moderately negative. And just as a reminder, we have 4 factors that we believe drive asset class returns. So that's valuations, economics, financial conditions, and sentiment. We can see valuations very strongly negative. Now, this is, contradictory to what we've seen in SA. So US equities, we know, are very expensive. Economics, moderately positive. So this ties into the improving global growth outlook. And one of the factors that we actually look at here is the PEI. And that's what Rupert had taken you through at the beginning. Financial conditions, neutral. They've actually become a lot less tight as we've moved over the quarter. Despite the fact that we still have quite a tight monetary policy, there are actually other factors that goes into assessing financial risk. And then sentiment also turned positive over the quarter, so a lot of positive moves. If we dig a bit deeper into the sub-factors, so what actually drives these top-level valuations, economics, financial conditions, and sentiment scores, we can see that, starting with valuations, all of these indicators are in the red. Let's go to the price to earnings ratio because that's something that most people are quite familiar with. So we see that the price to earnings ratio has been running since October 2022, and it's just come off this peak here, but currently it's still sitting quite high above the long-term median, and it is still quite high in relation to its history. Not quite what it was maybe during COVID, but if you're sitting at a multiple of around 24 times, you've got to question, is this stock, is it actually justified to be sitting here? If we break down the price to earnings ratio into its components, so price and earnings, we see that actually over the past 18 months or so, earnings have been pretty much flat. It's really just been the price that's been moving this. So we've got to ask ourselves, is this justified? And what's actually contributed a lot to this price movement has been people feeling very bullish about the theme of AI, and they're actually quite optimistic about earnings growth in the future. But from our perspective right now, this, US equities are overvalued. Economics, we've spoken about this before. A lot more positive indicators coming out from here. I'm not going to go through this again, but essentially we are seeing an improved economic growth outlook. Financial conditions, yes, we know we still have a tight monetary policy, and it doesn't look like the Fed's going to cut rates anytime soon. So yes, tight financial conditions from that perspective, and we do still have an inverted US curve slope. However, there are other indicators that drive financial conditions. For example, credit spreads. Credit spreads have become much tighter over the past couple months. Now, we proxy this with US corporate investment grade credit spreads, and essentially what that just gives you is the difference between an investment grade bond yield and a risk-free bond yield. When that spikes from an already high level, it just indicates that there's more risk in the market, and therefore investors would not want to be going into risky assets. They'd rather retreat towards more safe haven assets like US treasuries. So in 2020, we saw it spike. 2008, we saw the same thing here. What's been happening over the past couple of months, we've actually seen it tighten, indicating that actually, from a financial conditions perspective, there's actually less financial risk, which is positive for a risky asset class such as US equities. And then finally, sentiment. So sentiment has actually improved over the quarter. Business and consumer sentiment have become a lot more positive. Now, these two are leading indicators of economic growth. So, that's quite positive when it comes to the economic growth outlook. Consumer sentiment, bright blue, so it's become a lot more positive. And this also feeds into the narrative that we spoke about earlier, that the US economy is still quite consumer driven.
Okay, thanks, Shriya. Rupert, so, obviously what we've said here is, off the back of Shriya's evidence, is that things have changed and there's a little bit more positive sentiment in markets, particularly consumer sentiment and business sentiment in the US is strong. And we've seen sort of the counters in the tech space, IT space doing well off the back of strong earnings. So that remains, the AR story remains positive. But what's interesting domestically is that we've shown some other South African assets are looking interesting, and it looks like there's a bit of rand strength that's come into the market. How do we play that, and what about asset allocation given what we've just spoken about?
Yeah, so the rand is, as always, a roller coaster. It goes, over the last couple of months, it's gone from 1850 to 1930, back to 1850, back to 19, and so it goes on. So it's driven by a couple of different factors. There are SA-centric factors, like the yield profiles you get in our bonds, the carry trade, which I mentioned earlier, but it's also driven by risk attitudes around the world. So once global markets are happy to take on risk, then they potentially buy into emerging market currencies like the rand. So I think it's important for us to separate out our long-term structural view on rand volatility and our tactical view on the rand. And we do that within all of our portfolios. We engage in currency hedging, which means that we actually don't participate in that journey at all for that portion of the portfolio that we currency hedge. It's not the whole offshore exposure, because at times it does benefit you when the rand blows out from 18 to 1950, and it can hedge off some of your bets. But if you play that in the entire offshore allocation, which for us is generally around 45%, it adds too much volatility to your portfolio. So we hedge roughly half of the currency, which means that the rand goes from 1850 to 1950, we don't participate. The rand comes back to 1850, we don't participate. We're just making a cent, 2 cents every day on that currency hedge. So it gives you that smooth, steady path, which is what we're looking for our investors.
Rupert, thanks for that view on the rand. Look, these geopolitical situations and the considerations have been significant. And this year we know about 2 elections that will probably affect us the most. First globally in the US, and then secondly domestically in South Africa, elections around the corner. How does this consideration around asset allocation, protection, around rand exposure, assets, give us a little bit of insight into what we should be doing there?
So we never put all our eggs in one basket for exactly this reason. We don't want to bet the ranch, so they say. So we've got a large amount of offshore exposure, not just to the United States, to global markets. So emerging markets, developed markets, fixed income, equities all around the world. In South Africa, within in particular Reg 28 funds, we have to have 55% exposure. So we've got South African exposure as a start. Now, how do we sit when it comes to the South African exposure? What have we gone through in terms of the last, let's say, 6 months in pricing and rand assets relative to global assets? So there's been underperformance of SA assets, especially in the first quarter. And if you think of it in the way of pricing of risk premium, which often we do, what that means is that you've got a very cheap SA equity market. You've got bonds with a very, very high yield. So think of that like a risk premium. What that means is that the world, global markets, and South African participants have now priced in risk in South African markets. So we think that's largely priced in. If there's a bad outcome, whatever that outcome might be in the elections, then potentially there might be a sell-off in equities, but it certainly won't be as big a sell-off as it would have been if SA equities had a PE ratio of 20, right? With a PE ratio of 10, touch wood, there's not too far to fall. But what I found very interesting has actually been the pricing of protection in these strategies. So this just talks towards my point is, are market participants paying significant premiums for putting on protection in those asset classes? So let me show you that. Right, so if we look into implied volatility, which is, in my mind, what we can translate it to is the level of premium, insurance premium, that market participants are willing to pay, which naturally would go up if there's a higher level of perceived risk, and does do exactly that in periods like, if you focus on the dark blue line, the level of volatility priced into the market in 2008 and in COVID. What we've seen is that in South African equities, that level of volatility is not spiking at all. And then if you look at the skew, which is the way to see where the market participants are pricing for directionality in the market, again, not really suggesting anything. So interesting when you look at the options market in terms of how that relates back to South African equities. And it's exactly the same or a very similar story when we look at currency. So one would think that the rand might blow out to 25 rand to the dollar, which means that some market participants would want to buy protection. But again, that level of implied volatility, nothing to write home about. And the skew also hasn't significantly spiked.
Okay, Rupert, thanks for that. So we've seen domestic pricing assets, some opportunities, and obviously there's 55% of the portfolio that's still going to be concentrated in South Africa. Shriya, in the multi-asset space, particularly in Reg 28 funds, we've seen the asset allocation shift quite dramatically over the last few months, where when the Reg 28 changes came in, there were a few managers that maybe didn't move as quickly as we did to take money offshore. It seems like a lot of the peers have now started to move. Maybe just some reflection on that change in Reg 28 portfolios.
Yeah, sure. So Rupert actually mentioned, I think it was 2 webinars ago, that we'd been working on this project to track the peer group and to actually see what they were holding through time. And we've actually finalized that project now, and essentially we're actually able to track the allocations without relying on a fact sheet or a quarterly exposures report. Essentially what we did was we took asset class building blocks, so from South African equities, DM equities, US bonds, SA bonds, and we built a model that was able to combine these asset classes in a way that could get us to the return streams of every asset manager in the peer group. So if we're talking about our balance funds, then we'd look at the South African high equity category. So we did this and we tested our models. For those who are more technical, we did test it out of sample, which basically means that we were able to test the model on data that it hadn't seen yet, which statistically makes it more accurate. So we were very happy with the results. We actually found it to be more accurate than what the fact sheets were showing us. So we've got a lot of confidence that we were able to do this quite well. So let's have a look at the results. Okay, so we performed this exercise on an aggregate level, and this is essentially the factor-based allocation that is most recent. So starting with offshore, because that's what we're interested in right now, we've got around 15% allocation to DM equities, around 11 to 12% on emerging market equities, 14.5% to offshore bonds, and then a little bit of cash sitting at around 7 to 8%. So essentially this means that almost half the portfolio is actually offshore. Now, how does this look, how did this look over the past couple months? Because we see that the offshore allocation, so we look at the unhedged dollar exposure and the hedged dollar exposure, and we see that steadily increasing since 2022. So, that's 100% spot on that our peers are actually moving more and more offshore. We see it a bit more clearly if we just look at, the rand exposure, and we see it did come off here quite steeply at the end of 2022, and it's steadily still coming down. So that just gives us confidence, that our peers are moving offshore. We of course did it very early in 2022 because we are systematic, and so we had to follow our process.
That's a very interesting analysis. Rupert, the importance of that for us is?
Great question. So some people might think, why do we want to know what the peers are doing? So for our funds, they're peer cognizant funds. We don't want to be too far away from the peer group. Now, that's not to say we're not going to be different from the peer group. In fact, we want to be different from the peer group. But we don't want to be underperforming the peer group by 10%, right? That's not where you want to be with your clients. Likewise, if we're outperforming the peer group by 10%, there's probably something wrong in our fund. What we're trying to do here is to outperform the peer group as consistently as possible by small amounts, and that's kind of the Prescient approach. So we're looking for, let's say, 50 basis points, 1% every single year. And by doing that, you get this compound cumulative product on your performance, which takes you right to the top. And our balanced fund is actually approaching the 10-year track record now, and we are almost the top fund in category. So it just shows that it really does, slow, steady outperformance does get you to the top.
Rupert, I think the point you make there around not being shooting on the upside or, worse on the downside through this is that, in fact, this category, which is the multi-asset high category, is being used significantly by clients and financial planners to build portfolios, and therefore there is an implicit target that is built in the mandate, which says deliver X percentage above inflation, and therefore the client must expect what they're getting is, it's written down, and they must actually receive that performance. So I think this is true from what to expect and what you're receiving. So I think through that broad category, there has been this distinction that some people were not going offshore and others were, and now we've got this sort of dichotomy. But I think the long-term view is that over time, Rand will depreciate, global asset allocation to other assets will benefit clients. Again, it probably comes back to the point that the usage of these funds in this financial planning process has great merit.
Yeah, exactly. You want the full diversification of these products within client portfolios, and that's exactly what we're trying to do. So overall, we've got about 5,000 different equities within the book. We are very much active, so don't get me wrong, we're not a passive fund at all. We're active, we play the asset classes. Shriya showed you some of the asset class views, but we do so in a very cost-efficient manner and highly liquid. So what that means is that when our views change, we trade on the day towards those views. We're not a passive fund. We don't rebalance once a year, and we rebalance our portfolios every single day to the house view.
Okay, that's important. So active is key. Okay, we're starting to reflect on a fund range effectively. Maybe let's just talk about what's in the multi-asset arsenal of product that we can show or share with our investors.
Yeah, so I think we try to hit every single category within the ASISA world. So we've got a defensive fund, which is low equity category. That's got a large exposure towards fixed income type instruments. We have exposures there towards income type exposure, like income funds, for example, bonds globally and in South Africa, income assets globally, but we've also got a smaller slice of equity exposure. In the SA space with SA high equity, as you mentioned, it's the most popular category for fund managers in the country. So there are now over 230 funds in that category, quite a competitive space. But again, we're looking to deliver a long-term return target of CPI +6, and to do that with the lowest amount of risk possible, which means that we've got exposure towards global markets, SA markets, as diverse as possible. We've got alternative assets in there, which is things like clean energy investments into wind and solar, and all of those help us to navigate the cycle with a much smoother volatility profile and to get towards those client goals.
So that's on the domestic front. Then we've also got a global solution as well in the multi-asset space.
Yeah, so we've got a global balanced fund, which is a UCITS fund on our Irish platform, and that gives you also CPI +5 to 6, similar to our SA high equity offering, but it's 100% global asset classes. That's offered both offshore via UCITS funds and also via a feeder fund in South Africa.
Thanks for the overview on our fund range, Rupert. That's important. So I think just from we're going to be sitting in this chair in a couple of months' time reflecting. So we've said outlook it's changed from the beginning of the year. We're expecting to see interest rates start to be cut internationally and domestically. We find some good opportunities from a South African perspective, but I think the beauty of obviously the multi-asset team and the portfolio construction process here is that we're looking for assets globally, which benefits clients. So you're not just getting a single domestic country risk, you're getting multiple asset class risk, you're getting multiple currency exposure risk, and other alternative assets that are included in these portfolios. So I think a wonderful solution for clients. So our funds are available on the majority of the South African list platforms, as well as on the offshore platforms for the UCITS funds that Rupert mentioned. And obviously these are being used by advisors and our discretionary fund manager clients. So please reach out to us or go to our website. You'll find our fund fact sheets or MDDs there, or please reach out to our BDMs and we'll be more than happy to engage. Thank you for joining us today. Appreciate the time and the input from the panel, and please join us for some questions.
Great, thanks everyone. There are quite a few questions, so I'll just try to focus on the top 5 one, which we have collected here during the presentation. So the first one is performance against the peer group. Talk about the alpha attribution. How did you manage to outperform the peer group this quarter so far?
Yeah, I'll take that one. So we've been quite happy with how the balance fund's done year to date. Currently, we're sitting above the peer group by about 40 bips, so we're quite pleased with that. And essentially, it's what the fund was designed to do, right? It's to be consistently above average over shorter rolling periods of time, and to take advantage of that consistency and compounding returns, and then to be, spend a lot of time in the top quartile over longer rolling periods of time. So if you look at, I think it's a seven-year rolling period, we in the top quartile almost 95% of the time. If we look at the performance in relation to our composite benchmark, so over the first quarter, most of that outperformance was actually driven by our strategic asset allocation component. And if we dig a bit deeper into that component, what was the main driver there was our structural underweighting to South African equities that actually benefited us. And then overall, the key driver had been developed market equities that had, really helped us with performance over the quarter. So yeah, we're quite happy with how the fund is done. We will continue to, position it accordingly to whatever's happening in the macro environment with our TAA views, but we will remain, structured or rather positioned anchored to our strategic asset allocation in the long run.
Well, thanks, Shriya. I think that covers the first one. The second one is the US labor market is now cooling slightly. Will it roll over in the second half of the year? I will actually cover that one. We see the cooling as well. So the labor market is definitely cooling, especially if you look at forward-looking metrics like the hiring rates coming down, wages are coming down. You can also look into voluntary job separation. So that's basically people leaving jobs, choosing to leave their job because they are moving to higher paid jobs. And that turnaround is basically also coming down. And then we've got the job opening rates, which we often read about, also coming down. So a lot of metrics are suggesting that the labor market is cooling quite significantly, but we think it's a good cooling. It's not that it's supposed to roll over yet. We can see that metrics like the unemployment rate or non-farm payrolls, other than maybe the last print, remain incredibly strong. And with that, you're actually engineering the perfect soft landing, like labor market cooling, labor market being less inflationary, no inflationary pressure through wages or dissipating inflationary pressures from wages coming down, but no signs of rolling over yet. So if I look at the labor market, actually only good signs. Okay, cool. Next question. What are we looking out at Prescient what are we looking out for in the coming quarter? Okay, I guess that's more a macro question again. I will cover that one as well. Part of it I have covered already in the previous question. I guess it's about inflation and the global growth outlook once again, because that will define what monetary policy is going to look like in the months to come. And yeah, we are very tied to what the Federal Reserve is doing when it comes to asset class returns. So it's really all about the Fed once again, and that's what we will keep the biggest focus on. We are not going to neglect event risks like the US election at the end of the year or the SA election at the end of this month. But I really think what the Fed is going to do is going to be most definitive. So what is the Fed going to do and what it's priced for? So it's priced for just one cut at the end of this year now, which is a quite hawkish stance. So we do think that actually there's room for inflation downside surprises from here. Sounds wrong to say that because we are all suffering from a recency bias with so many inflation upside surprises over the recent history, again over the last 3 months. But if you dissect inflation into the last detail, you can actually see that it's mostly the shelter component which has been driving these upside surprises, and the shelter component has started to continue its downward journey. So with that, yeah, maybe some good news later down this year, maybe some downside surprises on inflation, and with that, hopefully also potentially more interest rate cuts which are priced right now. So there are no reasons to be too hawkish or too pessimistic on that. I'll move on to the next question. Again, linked to interest rates. So I'll leave this one to you now, Shriya. How do interest rates affect your funds? Do you benefit from rates coming up, or do you benefit from rates going down?
So that's a really good question. I think rates have been on everyone's mind. So why do we even care about this? So we are active in our fixed income space, and we've taken longer duration over the past quarter. And so with rates, climbing higher and higher, it has detracted. But again, let's look at our equity building blocks. So there we overlay portable alpha, and again, the story is with rates moving higher, it will detract from performance. However, where we sit right now is actually a really good position, because the likelihood that rates move even higher, don't quote me on this, is pretty minimal. So the direction that rates would go now is down, which would benefit us in this space. And then if you think about it in the context of emerging markets, so naturally, a higher dollar and higher base rates is negative for emerging markets, and we position ourselves strategically a little bit more towards emerging markets. So that has hurt us a little bit. However, we know the journey forward is going to look up. If you think about it, if the Fed were to cut rates sometime, not saying when, what would happen, or what the position is in the US right now, is that we've got an inverted yield curve. So the rates at the front of the curve are quite high. And we've seen a lot of money come out of emerging markets and go into the US to get a hold of those yields, because why would you want to take on emerging market risk if you can get it in the US? That's it's a safe haven asset class, or developed market bonds are. So when those rates start to come down, what we want to see and what we hope to see is more flows coming into emerging markets, more flows coming into South African bonds, and then we'd participate in that price appreciation. So in our balance fund right now, we've got around 10% allocation to SA bonds, and so that's positive for us.
So basically, having been repriced from 7 cuts at the beginning of the year to just 1 cut this point of the year has been a natural headwind to the fund, but again, we've beaten the peer group by more than 40 bips. So even in that environment, the fund is doing what it's supposed to do, but obviously even more attractive environment ahead going forward. The last question is on alternatives. Do we hold alternatives in the fund? We mentioned already in the webinar that we do, but the question is also linked to what are the benefits and what are exactly those alternatives and how do you run them?
Okay, I'll take that one. So yes, Rupert did mention that we have a clean energy and infrastructure fund. In our balance fund, we have around 5% allocation to each of those. And those 2 funds are actually run in-house by our lovely credit team. So we're quite happy about that. And we get access to that at 0 fees. So a huge benefit, from that perspective, but also from a diversification perspective. So the returns you're getting there are uncorrelated with your South African equity market returns, and it's quite a strong story from that point of view. On the and then another thing is that you're getting a very attractive yield profile there. So you're getting around CPI plus 5 to 6. Which is great in a balance fund that has a target of CPI plus 6. So we're very pleased to have that in our fund.
That's great. Thanks, Shriya. There are a few more questions, but in the interest of time, I think we'll leave it at that. We will go back to you on the other outstanding questions and answer them via email. But from my side, just thanks everyone for participating, and please join us for the equity one, and please join us for the future webinars. Thank you.